Types of unit trust. Now, there are two main types of unit trust. One is the open-ended and one is called closed-ended. The reason is how the units are being measured, how they control the units. Open-ended means the units are, number of units can be created easily, can be cancelled easily. That's why you always deal with the unit trust management company. Those are called open-ended. Closed-ended are something like your stock market. You want to buy, you have to wait for somebody to sell. You want to sell, you must wait for somebody to buy. That is called closed-ended. The number of units are fixed already. So you have to have buy and sell among the investors. Whereas open-ended, the number of units can be created by the trustee and can be cancelled by the trustee. So there's always a ready buyer. Now let's go through more. Units are not quoted on the stock exchange. Because when you buy and sell, you go through unit trust management company, right? These are called the open-ended. Whereas the units quoted on stock exchange is a closed-ended. Okay? So clear? Remember, closed-ended like share market, open-ended like unit trust. Although the open-ended, they are more than the stock market. Okay? But just imagine open-ended unit trust, closed-ended are stock market. Just to understand easy. So units are quoted stock exchange, closed-ended. Not in the UTMC pricing is open-ended. Unit trust, stock market. Right? Second one. Unit prices are computed based on the underlying net asset value. This is closed-ended. This is unit trust because the unit trust prices based on the bond, money market, fixed deposits they have placed inside the fund. They calculate, divide by the number of units, you get your unit price for the day. Those are open-ended. And the closed-ended is determined by the market forces. Like stock market, depending on every minute, every second, there are buyer and seller, the price will change up and down whole day. Whereas unit trust, no need to change. End of the day, they calculate tomorrow, you know. So it's very straightforward. You only know once a day. Or closed-ended stock market, changing every minute, every second can change. Clear? Third difference is, prices remain unchanged with the same rate. Like I mentioned to you, it's only calculated once a day. Whereas this one, changing throughout the market, open. Okay, that is the stock market, closed-end funds. So far, right? The left side is all the open-end, the right-hand side is all the closed-ended. And the funds will increase by recreation and will decrease by the cancellation. So these are all the open-ended. The trustee will cancel and create the units. Whereas for the stock market, there's no new units unless they say they will announce new rights issue, new bonus issues, then only the number of units will increase. Or else remain the same as long as there are no other new changes. Those are the closed-end stock market. Alright? And the last one, you deal directly with the unit trust management company, whereas the closed-ended, you deal with the stock market, the Bursa Malaysia. The trading is done through the Bursa Malaysia or the exchange. In the unit trust, we talk about equity funds. However, equity funds, we also subdivide them into many more subcategories. The main one is maybe called aggressive growth fund. As the name mentioned, they are more aggressive, they invest more into more equities who have a high potential of up and higher returns than the GDP. So it's under growth funds. For index funds, they link to the part of the component of index. Let's say KLCI got 30, right? They invest part of the 30 companies. This whole thing are called equity funds. Alright, this whole thing is all equity funds. Income fund, they are more into those giving dividends. Alright, they are equity stocks funds, but they buy stocks that give a lot of dividend. And international fund is where they invest overseas. So these whole things are called equity funds. So equity funds has a lot of variations. All these equity funds basically they invest in stocks, invest in shares of a company. Alright? And then they have different category where they focus into different types of companies. If they focus a lot of companies that is growing, has a lot of potential to be bigger, they go into growth funds. If the companies are really big, and they are component of an index. Let's say the KLCI index or Bursa Top 100 index. Those are under index fund. They only invest into companies that is part of the index. So like Maybank, CIMB Bank, Public Bank, Tenaga National, they are main KLCI index, right? So if this fund only invests into these big companies, they are called the index fund. Alright? And if they focus a lot on dividend, if they invest companies that give a lot of dividend, a lot of returns, they will categorize under income fund. They are still stocks, but companies that give good dividends every year, maybe 3-4 times a year. Right? And the last one, international fund, is where they invest overseas. Let's say the fund by China, Australia, US, this is called global funds. And global funds is under international funds. Then as long as the fund invests outside Malaysia, they are called international funds. Okay? Now, bond fund, they are nothing invested in stocks. They are all borrowings. Bonds are actually borrowings. They borrow from people. Let's say, for example, they want to do a project. Let's say the high-speed rail from KL to Singapore, right? Now, what they do is the company needs money. They have money, but not enough to buy all the land, to build all the construction, and then buy the trains, everything, the stations, all that. They have too much to spend. They will borrow money. So what they do? They use bond to borrow money. For bond, is a very long-term borrowing, and the return maybe 20 years later. You lend the company 1 million, you only get back your 1 million 20 years later. Right? However, they do the bond trading as well. They buy and sell bonds. Okay, I don't want the company only, I want to sell the bond to somebody else who want to buy, then they will negotiate the price and sell to each other. Okay? But the bond will only get back a maturity 20 years later. Your 1 million will be get only 20 years later. That is all long-term borrowing. Right? They provide regular income. Why? When you lend people money, you expect interest, right? But just like the bank, when they lend money to you, you borrow money from the bank, you expect to pay the interest on a monthly basis, right? The installment plus the interest, the amount of money to pay, reduce the loan amount and the interest, that is where you get regular income. Every month they got the interest payment. Okay? Or every 6 months or every year. They receive return from the investment. So that's why they get a fixed income. So that's why sometimes bonds are also known as fixed income investment. Not income, income is like equity funds. These are called fixed income. Why? The interest rate are already specified when they buy the bond. 5%, 20 years. So you get 5% every year for the next 20 years. Okay? And they are more secure. Why? Most of them has a project there to pay off the lender, the creditors, in case something went wrong with a bond. They may have a building or a land or project that can have some collateralized loan. Okay? And they have a portfolio diversification. If you put all your money into stocks and if the market crash, what can you do? All your money are gone, right? So what they do, the fund manager will normally diversify a little bit into bond. Just in case the market crash, the bond are secured, they receive fixed income on yearly basis. And they buy many bonds. So maybe January they receive a few bond income, February other few bonds income, March. So they have regular money coming into the investment. So alright. So the main focus is income. Bond funds are income. Capital, they are not really too focused on that. If have increased, don't have increased, not the main focus. Okay? Not only bonds, they also have money market. So equity fund will have equity, bond, and money market. Most of them will have all three. For bond fund, you have two. Bond, money market as part of the structure. But if you are money market, they only have one, money market. So equity have three, bond have two, money market have only one. Money market only money market products. Equity have all three. Bond fund will have money market and bond products. Okay? And no, corporate bond, government bond, money market. Government securities are government bond. They either buy the bonds from the government or they buy bonds from the corporate. These two are under bonds. Deposits are the one that normally puts in the bank. Like FD or lending, they put the bank for a short while, maybe 1 month, 1 week, 2 weeks. That is called deposits in the bank. So deposits are money market. Okay? Bonds are always for long term. 10 years, 5 years, 20 years, 30 years. Money market are very short term. 1 month, 1 week, 2 months, 3 months. Most of them, in fact, 90% must be less than 1 year. So they are very short term, very secure. You know why the bank is borrowing money and they will return back the money from you to you. Just like FD. Balance funds. Okay. Balance funds, instead of equity, they say, okay, I want to have mixture, right? Capital gain and income, right? Remember just now the objective, capital gain and income? So they will have a balance, maybe 60% equity, 40% in securities, fixed income. So they have bond 40%, equity 60%, or 50-50, or 40-60. So they play around 40 to 60% equity and bond percentage. So they have capital gain, part of it, and income, the other half. Alright? So they exhibit a lower volatility because why? Not everything is equity. Equity are very volatile, up and every day. Bond, they are more stable. So you will have less price changes. Second, limit of the equity maximum 60% only. So not so risky like the normal. The normal equity can go up to 98% stocks. So in fact, basically they can buy everything in stock market. So it's going to be very volatile in the market up and down like now, right? Up, down, up, down. That is the volatility of the investment. Bond fund, if it's bond fund only, it's not in the stock market, very stable. Money market is operate similar way to a bank account because basically you have the money, you place into the bank and the bank will use your money to do their business and they will give you interest. Right? On a regular basis. You put in FD like 1 month you get the capital. Let's say you put 10,000, you get back your capital of 10,000 and you get the interest maybe 3%. Okay? Unit price are already fixed amount. Let's say 10,000, you get 10,000 plus interest. Right? You invest in low risk money market instruments, they put in a bank, savings and all that. Plus highly liquid, where you can get back your money in 1 month. Some of them even shorter, 1 week. So the fund manager will put the money into the savings account or fixed deposit account in the money market. They will get back the return on regular basis and they will increase your bond at the money market value. Your unit price of money market will slowly go up. Very, very stable. I've never seen money market negative return before. Always go up one. Right? That is the nature of the money market investment. The highest risk will be equity, balance, bond, money market. Right? Equity risks are higher. If you have foreign, normally higher risk compared to local. Why? You got foreign exchange and you got your country risk. Alright, I repeat again. Highest risk is equity, followed by balance, bond, and money market. Money market is the most safe in terms of risk level. The REITs. REITs are actually a short name for real estate investment trust. REITs are actually a pool of money, something like the collective investment scheme. Just now I remember we talked about that. But instead of buying companies, shares, and bonds, they buy properties. Pavilion, KLCC, your mid-valley is under IGB. Those are REITs. So instead of buying the whole mid-valley yourself, you buy their REITs. So a company, let's say IGB want to have mid-valley, right? They're not going to spend all their money to develop the whole mid-valley shopping mall. What they do is, hey guys, I'm going to have a very good shopping area here and I'm going to collect money from you investors. Please pay up the investment and then we will use the money to buy and build the shopping. People invest, buy the REITs, the IGB company take the money from the REITs and build the shopping mall. So what the income from them is the rental of the shop lots. They buy the buildings. Not only building, they also have hospitals, REITs, they have plantation REITs. Money, they buy properties and shop lots or factories or whatever, and their main focus comes from rental income plus the appreciation of the building. When they buy the land, it's quite cheap because it's empty, right? But what happens is they develop the land and become expensive already. So that is where the REITs money make more money, by the capital appreciation of the building. You got the idea now? And then they are listed in the stock market and they can bought and sold through the stock market. No, just normal like stock market. So what happens is our fund don't buy the building, they buy the REITs. Right? So our fund buy the REITs indirectly, we are buying the shopping mall, the KLCC as well. But because we cannot buy the building directly, we buy through REITs as the investment diversification. They are all listed, they are just like stock market. I mean, they are just like company stocks. But the structure is stock market, you buy companies, businesses. REITs, you buy the properties of the company. The stocks and REITs are listed in the stock market. They are all closed-ended. For real estate. Real estate is buildings and properties. So the other one is called ETF. ETF is another type of investment. It's exchange traded fund. These are also another way of investment. Stock market has a lot of things. Right? That's why we don't call stock market, we call equity market. Our fund manager don't only buy stocks, they buy REITs, they buy ETF as well. Okay? ETF are something like you are buying the index. So what they do is, the investment objective is same as the index. So instead of you buying KLCI, you can't buy KLCI because nobody sells you the KLCI index. You understand? Nobody sells you the KLCI index. KLCI index is still a calculation based on the share prices of all the different companies. So to sell the KLCI index, instead of you buying all the KLCI component companies, that is going to cost you a lot of money because they are top 30 main companies and all of them are very expensive. You may need a few hundred thousand just to buy 1,000 shares each. So they use the ETF. So ETF was formed by another company. They said, okay, the price changes of the ETF is exactly the same as the index. If the index go up 10 points, the ETF also will go up 10 points. If the index go down 10 points, the ETF also will go down 10 points. Exactly same percentage. KLCI is 1,008 now, right? Let's say 1,008.50, right? Now, you cannot buy KLCI index because there's nobody selling you KLCI index. So what they do is one company saying, okay, I got KLCI ETF. I use the money and buy companies and the number KLCI and this company shares about the same number. They will follow exactly as a KLCI index. The price go up 10%, my ETF also will go up 10% in value. Now you can buy the ETF. Some company form this vehicle based on the index and make it a product to sell. They buy shares of these companies. So this is what we call, they invest in the securities representative sample in the index. So they buy the shares reflecting the index itself. Because indexes are based on shares. So what they do, they will buy the shares of the index, so they follow exactly like the index. So if they have KLCI, which means they will invest into the KLCI companies, listed component companies. KLCI got 30 companies, they will follow exactly. Alright, they will have their own calculations to follow. So KLCI go by 1%, this ETF also will go up by 1%. If KLCI down 5%, this ETF also will down 5% because they are exactly the same percentage. Right? And they normally will have a low expense ratio. Why? No need to worry so much. No need to do fund manager. Just buy and follow the index only. Then the ETF will go up and down exactly the same. In terms of percentage, because the ETF is like 1 ringgit, 2 ringgit and all that, whereas the TLCF is 1,800. You see the difference? 1,800. So they will have 1 ringgit 85 for your 1,850. If TLCF go down to 1,008, then your ETF will be 1 ringgit 87. So our fund manager will buy indexes instead of buy companies separately. So they buy the ETF straight away like index rate. And they bought and sold through a stockbroker, just like a listed share or REITs. So they are REITs, ETF, and stockbrokers are called the equity market. Okay, although we always say stock market is equity, equity is more than stocks. They are REITs and ETF, warrants, everything are also inside. Okay, another one is Sharia Funds. Standard, follow Sharia products only. So companies that is Sharia compliant can be invested by this fund. If it's not Sharia compliant, tak boleh beli. Cannot be bought. Alright? Invest in portfolio of halal companies, Islamic debt. So even they have excess money, right, they cannot put in the FD. They must put into the Islamic debt instruments or Islamic banking. Alright, and then returns will have no fixed interest. The main reason is companies like Maybank, Public Bank, CIMB Bank, they are non-compliant because they give fixed deposit, fixed interest. They charge people fixed rates, not allowed in the Islamic banking or Islamic financial rules. And these are all the government sponsored. This is where like the Tabung Haji, the ASN, ASB, they are more on balance basis. They have bonds and equities and all that, and they are also either fixed amount or variable amount, depending. A lot of ASB, all these are fixed rate, right? You buy 1 ringgit, you just have to wait until the dividend payout every year, right? The capital gain is none. It's only dividend received. Now, stock market give dividend. This fund sponsored like ASB, ASN also give dividend. Unit trust give distribution. They are completely different. Huh? Why? Unit trust, the money take out from your own, give back to you. Whereas dividend, your 1 ringgit still remains 1 ringgit. There's no capital gain, right? They only give you the dividend. Like EPF, they give you dividend. You got 100,000, they cannot take your 100,000 return back to you. They say, hey, EPF money properly. No, it's the same 100,000 with that, they give you extra money. That's why it's different convention. Named differently. Okay, EPF, ASB give dividend. Unit trust give distribution. Tak sama. So they have a fixed amount of money unit ringgit per unit price. That's why these are all different. The way they measure and calculate is different from unit trust. But they are also under the collective investment scheme. Now, Sharia funds or Sharia unit trust funds are basically more for the Sharia concerned investors. They say everything, I want to follow my religious belief, and I want it to be all accordingly. That's why we have Sharia funds separately from the conventional. Sharia funds got no gambling, got no liquor, got no tobacco. So they are very focused on halal companies, Islamic debts, bonds, and everything follow the Sharia principle. They have no interest in the investment. Okay? Okay, who are the ones regulated on Sharia? First, we have the securities law and regulators, SC. In SC, they have another group called Sharia Advisory Council. They call it short form SAC of SC. Sharia Advisory Council will advise Securities Commission related to Sharia matters. So they were the one who will list which companies are Sharia compliant and which companies are removed from the Sharia compliant. Alright? Normally, all companies try to be Sharia compliant, but if some companies cannot, means cannot lah. Like conventional banking, they got FD and all that, definitely cannot. But other companies, they try to be Sharia compliant. Why? More people can invest in your company. So the Sharia compliant Advisory Council are the one who monitor and check. Every 6 months, they will publish a report who are new addition and who has been removed because break the rules already. And there are some companies remove and then they will announce, okay, these companies are no more Sharia compliant, out. So the Sharia Funds manager will have to remove these companies from their investment. And this Security Commission will, Trustee and UTMC, all the same. Everything, the structure is the same, except there is a council and we have also another group called Sharia Advisor. We will appoint Sharia Advisor to help us to do all the operations. Okay? Okay, this is how UTMC are having a Sharia Advisor, or if they have permanent, they call it Sharia Committee. Sharia Advisor fees are not taken from your fund. It's taken by the company money. Right? The company pays separately. Right? Because why? It's just an advisory role. They are not focusing on each different fund. So they have the overall concept, so company have to pay separately, not part of your fund. Okay? So yeah, they are not part of your fund payment. The charges don't have Sharia advisory or Sharia committee fees. Okay? They also have the deed, prospectus, unitholder, exactly the same. The deed is which contract? 3 party, right? Which are the 3 parties? Unitholder, UTMC, and Trustee. So Sharia Funds also the same thing. It's just that they go extra Sharia Advisor. Okay? Alright, who are the things, what they do? They have compliance review, like I mentioned just now, every 6 months, last Friday of May and November every year. And they have a booklet, they will announce in the public website. You can go to the Securities Commission website. You can see which are the companies listed as Sharia compliant and which are not, and which is newly classified and newly non-Sharia compliant. So they have to remove. So you can read. Alright, and then what are the benchmark they determine to be Sharia compliant? Okay, compliance review, they will check either the services are got interest or not. Okay, there is amount. Basically, if it's not more than a certain amount, it's still approved. Okay, and gambling, hello, tak boleh. How about liquor, non halal, anchor beer, tobacco also not inside. Okay, liquor, tobacco, gambling, gaming, tak boleh. Magnet. Alright, how they review? Conventional insurance, out. They must be takaful ni. Entertainment activities, those, I don't know what, gambling, singing, karaoke, tak boleh. Manufacturer of tobacco, tak boleh. Stockbroker, also not inside. So you see, all financial companies normally are non-compliant. They have their own terms used in the unit trust, okay? Okay, for a normal unit holder, among the unit holders, let's say all of you are unit holders. Let's do the same case. These are all the trustee, these are all the fund manager, the rest of you are unit holder, right? The money that you put in, you among yourself under the musyarakah contract. How I remember? Masyarakat. Like masyarakat is a community. So the contract among all the unit holders is under musyarakah contract. Basically, the profit sharing will be based on your amount of money you put in. You put more money, more units, you'll be paid more. So this is how the units are being paid by distribution by even every unit. 1 cent per unit, 2 cents per unit, half cent per unit. So you got more units, you got more money now. It's profit sharing by the number of units. So it's a contract that they have. Okay, second one, buy contract. How I remember? Buy, sounds like buy and sell. Okay, buy and sell contract. Okay. Alright, when you put money in UTMC, you are having a buy and sales and purchase contract. So it's called buy contract. Okay? So in the Islamic, they call it buy contract. BAI. BUY sounds the same to me. Now, UTMC, when they receive the money, the UTMC has another contract called the Wakalah. Okay, how I remember? Wakil. They are a representative and agent for the money. So we put the money, they are keeping the money for us. They are representing us. That's called Wakalah. Comes from the word Wakil. That's how I remember Wakil, my representative to handle my money. My custodian. Okay, I trust you for you to take care of my money. That's why you become my representative, my agent, so-called my agent, my wakil, my wakalau. And then when the money are put into the unit trust scheme, because the money is given, right, and it's called the Wadia Yad Damana. So Wadia Yad Damana, I got no idea how to remember. Amana is the trust, the custodian. You take care. So that is let you take care of money. Amana. Wadia Yad Damana, Amana. Lebih kurang amana sini sudah ada. Okay. This is where before creation, why the money is paid to the UTMC first. The UTMC receive the money, they become the wakala, the wakil, and then the money is under their care. Custodian is the UTMC. So the contract Wadia Yad Damana is with the UTMC before creation. Now what happened is the UTMC receive the check. They will transfer the money into the units inside here. Okay? So once they put inside here, the money is under whose name? Trustee, correct not? So let's say my money now, I'm the unit holder, right? Pay money to the UTMC. UTMC become the Wadia Yad Damana, the wakala. But now they take the money, go over into this fund here. So now it's under trustee's name. So the whole thing transferred under a trustee's name. After units are created, the money they change into units. So it's under the trustee's name. The musyarakah among you guys, investors, still remains the same. But now the trustee is holding the money, right? So the contract of the wakala changed to the trustee's name, because now the trustee is your representative to hold the money. And the Wadia Yad Damana, the custodian contract, has been moved from the UTMC to the trustee. Now it's converted into your trustee will be your wakala, and the Wadia Yad Damana is under the trustee's name. Appointment of Sharia Committee is you first, as per everything, must be registered and approved by SC. At least the committee or advisor, we appoint an external party, at least 3 independent members and 1 full-time officer must notify SC in case they resign or retire, and in case the person not suitable, they must leave the Sharia committee or Sharia advisor immediately. So this is the requirement to be a Sharia committee or Sharia advisor company. Okay, our fund manager invested in this company for 10,000 ringgit. The company share, right? So let's say you are the company owner lah. You are the shareholder lah. You are the FBM, FCM, Berhad. So the share investment 10,000 buy the company share. So clear? Then in October 1st, the Sharia committee say, hey, this company become non-compliant already for whatever reason. Don't want to know. So become non-compliant, right? Now the share value at that day of closing price is 10,800. So there was a profit of 800 after a few months of investment. So what happened after they declared non-compliant? This is where after non-compliant, so the fund manager have to sell off the share because it's no longer compliant, right? But they cannot sell everything in one day. Remember, we got a few million and million of dollars of investment. You cannot sell everything in one day. Let's say you sell at 12,000, higher than 10,800, right? Once they announce, it's 10,800. But after you sell, it becomes 12,000 because you sell later. You cannot sell at 10,800. You manage to sell at 12,000. So anything above the 10,800 must be donated. You only can keep up to 10,800 only, because that is what is Sharia compliant and halal. Anything above 10,800, you have to donate away, because that is after the compliant, non-compliance already. So if you are non-compliant, you keep the money, is haram, no? Don't worry, the fund manager with the working with the Sharia committee and advisor will have to donate the money for us. Money are all Sharia compliant.